How you doing? I'm Big D. Welcome to the show. I do appreciate it. I hope you can stick around to the end because this is very important. And I think what is going on in the deep state media, along with deep state banking, central banking, things like that, you should know about these things. And unless you're researching it, you're probably not getting the information because deep state media doesn't want you to know. Now, the largest bank in the United States by assets and arguably the most systematic, important bank in the world, just told everyone it is afraid of new technology and what it means for their business model. JP Morgan chief financial officer argued that this technology is building a parallel banking system without the same regulatory scrutiny. And all of this worry comes down to a few lines in a bill called the Clarity Act. Now, that is currently being debated upon in Congress, but the debate it's not promising, in my opinion. The entire consumer banking business model is built on the back of one thing: consumer deposits. And for banks like JP Morgan, deposits aren't just money, they're the foundation of their business. But here's one of the biggest misconceptions about banking today: banks don't lend out deposits like a piggy bank, right? The way that banking works has changed drastically over quite a long time. In the beginning, you had full reserve banking. Centuries ago, banks kept all the deposit funds in reserves. They didn't lend any of it. Banks were like warehouses. They held deposits for safekeeping, and then if they wanted to lend, they would lend their own capital. And then in the 1600s, English goldsmiths realized that depositors rarely would ever withdraw every bit of money that they had in the bank. And so they began lending against their deposits. And this created fractional reserve banking by practices, not by law. So then you have fractional reserve banking, where banks will keep only a fraction of deposits on hand and then lend out the rest. Like they say, banks are too big to fail. Right. And that would create new money in process. This is what most people think of when they hear about a bank lending. It's actually just money printing. And this is how essentially around 97, 98% of money is created today. Money is created when commercial banks make a loan. And then fast forward to today, where ever since 2020 in the United States, there's actually no required reserve ratio for most deposits at all. Instead, banks are limited by regulatory requirements like liquidity coverage ratios or net stable funding ratios, overall balance sheets, or sheet health. So, in other words, banks can grow their loans and assets far beyond their deposits as long as they meet safety and liquidity rules. And I just want to make sure we understand that before we get too deep into this topic today, banks are in trouble. And this is the way I see it. Now, deposits are still important because customers provide the cheapest funding possible for banks. And they use this money to issue loans and invest in assets and make money. Now, banks earn their profits on what's called net interest margin, which is the difference between what they earn on the loans that they issue versus the payout to depositors. So if a bank lends money at 7%, pays depositors 1%, and the net interest margin is 6%. And that spread is the bank's core profit. Deposits are important because They allowed the bank to grow its loan book. It allows to issue more loans without having to rely on volatile markets to get the money. So it doesn't have to grow or to go and borrow money in the form of bonds, for instance, which trade on the open market in order to get money for making loans. More deposits equal more loans, then more interest income. Here's the big problem that has banks shaking in their boots. There's this new form of digital money called stablecoin that exist on blockchains, which are their distributed permissionless networks, which means there's no single point of failure. No company or government can shut down an account or block a transaction on these networks. They're permissionless. The stablecoin that are issued on blockchains also offer cheaper and faster cross member payments because there's no middleman or intermediary that charges fees in between the transactions. Instead, there's just code. And besides just being used for cross-border payments, there are cheaper and faster. People around the world with failing currencies also find great use for stable coins because they maintain their value versus currencies that are actually constantly facing hyperinflation. And that even will collapse, like the Iranian real. Iranian real is that's or the Venezuelan bolivar. You can look at many different currencies around the world and see that they're worthless. Iraq dinar is not far from those as well. There is a little more value to these. You can look at the Vietnam VND. Now, stablecoin issuers are companies who use or create these stable coins on blockchains, and they create them in exchange for money that they receive from stablecoin users. So I want to use a stablecoin. I take my US dollar, I basically buy the stablecoin from the stablecoin user. The stablecoin user will then take that money to go and buy a short-term US treasury to back up the stablecoin one for one. Now, the stablecoin provider's business model is that it's going to earn profit on the spread or the difference between what it pays out to me as a stablecoin holder and what it actually makes on the US Treasury that it has bought. Because these US Treasuries pay a yield. But as it stands today, stablecoin issuers don't pay any yields on the stablecoin, and instead they just pocket the profits that they earn from the interest that they're getting on those treasuries for themselves. So a user of stablecoin gets a cheaper way to send money outside of the banking system. That's also faster, but we're forfeiting the ability to actually earn yield directly from the stablecoin itself. Until now, the Clarity Act is proposing U.S. federal bill that's aimed at establishing a regulatory framework for digital assets, including some of the way that stablecoins can actually use in this financial system. And one of the key questions in the Clarity Act is whether stablecoin issuers should be allowed to pay interest or rewards to holders. If the stablecoin issuers can pay interest to holders, then they would directly compete with bank deposits because user could have a more technologically advanced form of money that's faster, cheaper, censorship resistant compared to your traditional banking deposits. In fact, this could lead to a massive shift in the entire banking system overnight if stablecoin users could pay yield on their deposits. I mean, it could potentially cause a run on the banks. And this is what these banks are afraid of. So banks, led by groups like American Bankers Association, have pushed for a ban on any passive yields on stablecoins, arguing that if stablecoins paid interest, then trillions of deposits would leave regulated banks, and that would reduce funds available for loans to be made for homes, small businesses, communities, because stablecoin users don't offer loans yet. Now, stablecoin advocates that have pushed back, saying that some rewards are necessary for adoption. For example, activities-based rewards like cashback for spending or incentives for cross-border transactions could help stablecoin function as a real-world payment tool. Now, in the most recent draft of the bill, there was a comparison where it banned the passive yields and interest just for holding stablecoins, but it allows for activity-based or usually linked rewards. And the idea here is that this would protect banks' deposits base while still letting stablecoin grow as a payment tool. JP Morgan sees this as a real threat, and the banks really aren't happy with the compromise. We've also seen last year JP Morgan actually started experimenting with blockchain and actually launched tokenized deposits offerings right to the position itself for all of this future and how it might need to compete. And then Bank of New York Mellon is also doing the same thing. Now, we talked about how they're offering tokenized deposit solutions as well. I am not a financial advisor, and none of this is financial advice. You really shouldn't take financial advice from a random dude like me anyways. But stablecoins are here to stay. Now, with the Genius Act passed last year and the Clarity Act coming up, we are on a pace that has potentially massive for the adoption of blockchain technology. And there's a chance that publicly traded companies like the stablecoin issuers, Circle, might stand to benefit from the changes that are coming to the legislation here. And that's not to mention what benefits platforms like publicly traded Coinbase, crypto exchange, that might reap from the updates that are also being made to the law of this year, which could end up leading to a run in the price of crypto. We also have Robinhood being very active in the digital asset market as well. Now, we also have the fact that Ripple is a trade coin issuer and has quickly brought their stablecoin up to being one of the highest market capitalizations of all stablecoins. And though Ripple is a private company, they do not have a narrative digital asset that's called XRP that may at some point later serve as a necessary utility for how assets like their stablecoin, the RLUSD, move across the XRP ledger in the future. All in all, it seems that JP Morgan and a lot of banks are worried about the fact that these stablecoins might be eating their lunch and completely taking away one of the biggest parts of the entire business model. This little technology that they've scoffed at and talked crap about for years, deeply opposed to crypto, Bitcoin, etc. They've also pointed out in the past cases for criminals, drug traffickers, tax avoidance. If I was a government, I'd close it down. It is finally becoming a mainstream threat, threatening the entire existence. Crypto is real. And if you mean blockchain, stable coins, and you have a JP Morgan deposit coin, you can move stuff. Smart contracts are real. All that stuff is real. It will be used by all of us to facilitate better transactions, customer service. But I don't know. Maybe I've completely lost the plot here. Or how could I be looking at this differently? Everything money and markets. And if you got anything from this or whatsoever, be sure to like and subscribe. I believe many crypto are here to stay. There's some that might fall by the wayside. I believe IRS, the Federal Reserve, all are going away. The Treasury is going to be still here to stay. I believe Bitcoin, Ethereum, XRP, XLM, Pepe, Doge. There's so many that I can just start rambling off on. I think they're here to stay permanently and may even be part of the Treasury. But we're gonna have to see. These are only my ideas, but remember I said it. You try to have a great rest of your day, and God bless. Be safe.